Hi, everybody, and welcome back to Chapter 19 in Intermediate Accounting. All right, here we're going to be looking at accounting for pensions and post-retirement benefits. I find this particular subject quite interesting. All right, our learning objectives here are 1, we're going to discuss the fundamentals of pension plan accounting. Number 2, we're going to use a worksheet for employers' pension plan entries. Number 3, we're going to describe the accounting and amortization of prior service costs. Number 4, explain the accounting and amortization for unexpected gains and losses. And number 5, we'll describe the requirements for reporting pension plans in financial statements. Okay, if we preview Chapter 19 a little bit, we're going to be taking a look at the fundamentals of pension plan accounting, and they include pension plans, the role of actuaries, how we measure liabilities, and components of pension expense. Okay, now if we're going to also look at using a pension worksheet here for funded status and prior service cost amortization and funded status 2026. And finally, we'll take a look at gains and losses, smoothing unexpected gains and losses or assets, smoothing unexpected gains or losses liabilities, and corridor amortization and funded status for 2027. And then we'll take a look at reporting those plans and financial statements, the assets and liabilities, net income, comprehensive income, note disclosure, and some special issues. Okay, let's get into the meat of this chapter by discussing the fundamentals of pension plan accounting. Here, number 1, non-retirees' prediction of retirement income. Number 1, general economic conditions affect how Americans look at retirement. Number 2, the continuing political discussion about the fragility of the federal Social Security and Medicare programs may reduce non-retired Americans' comfort. And finally, number 3, many companies have benefit plans that promise income and other benefits to retired employees in exchange for services during their working year. A shift is on from traditional defined benefit plans in which the employers bear the risk of meeting benefit promises to plans in which the employees bear more of the risk. An arrangement whereby an employer provides benefits, payments, to retired employees for services they provided in their working years. If we look at a survey on comfortable retirement, we see that there has been a bit of a shortfall here, where perhaps people are not as comfortable in retirement as they would like. All right, if we look at the flow of cash among pension plan participants, an arrangement whereby an employer provides benefits or payments to retired employees for services they provided in their working years. Here's the employer, makes contributions to a pension plan, and that pension plan invests the money, earns some return on those investments, and those fund assets then are used as benefits for the pension recipients, the employees in this case. All right, pension plan accounting. the types of plans. Pension plans can be contributory or non-contributory. In contributory pension plans, employees bear part of the cost of the stated benefits or voluntarily contribute payments to increase their future benefits. In a non-contributory plan, the employer bears the entire cost. So in the case of a contributory, the one that comes to mind for me is the CalSTRS, which is California State Retirement System. And the employees of those educational institutions contribute about 10-11% of their money towards those costs. But the military, for example, those are non-contributory, and the military or the government bears the entire cost when that military person retires. A pension fund should be a separate legal and accounting entity. So let's look at a defined contribution plan. 1, the employer contributes to a pension trust a certain sum each period based on a formula. That's the employer. 2, the plan defines only the employer's contribution. It makes no promise regarding the ultimate benefits paid out to the employees. The most common form of this plan is the 401k plan. I'm very familiar with that, as I've set 2 or 3 of them up from scratch, and they're very popular these days. Okay, the accounting is straightforward. 1, the employee gets the benefit or gain, or the risk of the loss, from the assets contributed to the pension plan. The employer simply contributes each year based on a formula established in the plan. And as a result, the employer's annual cost, the pension expense, is simply the amount that it is obligated to contribute to the pension trust. Let's take a look at an illustration. Here, the Murphy Company sponsored a defined contribution plan for all its full-time employees that is administered by Fidelity. Fidelity is a very well-regarded outside investment company. Under the terms of the plan, Murphy contributes at least 1.25% of its pre-tax operating income to the plan each year. On December 31, 2025, Murphy reported pre-tax operating income of $2,480,000. Therefore, Murphy made a contribution to the plan of $31,000. So the questions: Alpha, what entry would you make to record the pension expense for Murphy's defined contribution plan at December 31, 2025? And Bravo, does Murphy have a liability on its balance sheet related to the plan? And they ask you to explain. All right. Alpha solution. Murphy records its contribution as follows. At December 31, 2025, it debits pension expense for $31,000 and credits cash for $31,000. Pretty straightforward. For solution Bravo, Murphy does not have a liability related to its pension plan. As long as it contributes at least $31,000, it has satisfied its obligation to the plan. Employers sometimes contribute beyond the minimum required in years of good profitability. Okay. A defined benefit plan outlines the benefits that employees will receive when they retire. These benefits typically are a function of the employee's years of service and of the compensation level in the years approaching retirement. Employees are the beneficiaries of a defined contribution trust, but the employer is the beneficiary of a defined benefit trust. Okay? All right. Situations that exist with defined benefit plans. 1, employers are at risk because they must contribute enough to meet the cost of the benefits that the plan defines. Number 2, the expense recognized each period is not necessarily equal to the cash contribution. And 3, the liability is controversial because its measurement and recognition relate to unknown future variables. All right, let's take a look at the role of actuaries in pension accounting. Actuaries are individuals that are trained through a long and rigorous certification program to assign probabilities to future events and their financial effects. Employers rely heavily on actuaries for assistance in developing, implementing, and funding pension funds. Actuaries make predictions called actuarial assumptions of mortality rates, employee turnover, interest, and earning rates, early retirement frequency, future salaries, and other factors necessary to operate a pension plan. All right, measures of the liability. In accounting for a company's defined benefit plan, we have 2 questions that arise. 1, what is the pension obligation that a company should report in the financial statements? And number 2, what is the pension expense for the period? We have some alternative approaches. There are 3 alternative ways to measure pension obligation. 1, vested benefit obligation. This measure is based on the benefits vested to the employees at current salary levels. Vested benefits are those that the employee is entitled to receive even if he or she is no longer employed by the company. Number 2, accumulated benefit obligation. This measure uses both vested and non-vested years of service. And 3, projected benefit obligation. This measure bases the deferred compensation amount on both vested and non-vested service using future salaries. Okay, so there's different measures here. And we're going to be using present value of expected cash flows computed by the actuaries. Here we have our vested benefit obligation, and that's the benefits for vested employees only at current salaries. And then we have benefits for non-vested employees at current salaries in the accumulated benefit obligation. And finally, we have the benefits for vested and non-vested employees at future salaries. That's the projected benefit obligation. And that is the FASB's choice. Okay, that looks like a good place for us to stop this video. And when we return, we'll take a look at measures of the liability continued. Until that time, bye for now.